Hello, everybody, and welcome to today's special webinar event in which we'll be providing answers to the question, will 2024 be a bigger year than 2023 in Australian real estate? I'm Terry Ryder, founder of Hotspotting, and my special guest today is one of the sharpest minds in Australian real estate analysis, Arjun Paliwal, who's the director and head of research of the award-winning buyers agency InvestorKit. We're going to talk about prospects for real estate markets across Australia in 2024 based on the unique methodology developed by InvestorKit as part of their business in helping investors develop strategies and achieve their goals as property investors. So Arjun, welcome.
Thank you for having me, Terry, and I appreciate the kind words and the shout out too.
I wanted to kick off by perhaps giving you the opportunity to tell our audience a little bit more about you and InvestorKit, but with the knowing that in the background there's a special event coming up for you tomorrow night. I think last year you won the Buyers Agency of the Year award, and you're hoping that tomorrow night at the award ceremony you might go back to back as winners of that title.
Yeah, thank you, Terry. That's correct. So tomorrow is the special night, and fingers and toes crossed, as they say, is where we're at. Last year, we were very humbled to take out the award for Australia's Buyers Agency of the Year. And whilst I'm lucky enough to sit here today, definitely the credit goes out to our team and obviously the clients who trust us to help them execute on those results. And so from that perspective, yeah, we're in the running today and tomorrow now to see if we are going to be the first to do back-to-back as Real Estate Business Buyers Agency of the Year. And yeah, that then would just be such a special recognition of what we're trying to do for our customers, which is transform their lives and build their wealth using research data and coming together with strategies that can scale their property portfolio beyond what traditionally most are doing in Australia. A bit about InvestorKit, I guess going back now, coming 6 years, 2018, I was a ex-banker turned to the buyer's agency world. And really, it was like most businesses where passion turns into the actuals of what you do. And so for us, it was investing in a property personally, both making good decisions, great decisions, and some poor decisions too. And from that learning, all of it came together to create a research methodology, both from a strategy level to actually scale a portfolio and a market analysis level to help time our entry into markets, because we know the long term of property investing is very forgiving in Australia. So therefore, investors should do all they can to time the market effectively, knowing that the long term is their protection. And so that's what we really set out to do and where we are today.
Yeah. So I've been watching the evolution of InvestorKit over the years, and always been impressed by the very heavy emphasis you place on research and the number of people you have in your business dedicated just to doing research. You don't just have an army of buyers agents out there. You've got a lot of resources put into researching. You've developed your own unique methodology for analysing markets and being able to give good recommendations to your clients about where they should be focusing their buying.
Yeah, so from the research side, Terry, there's something you led to there, which was around the research versus the agents piece. And that's one thing that we were always wanting to make sure we were known by, which is we're researchers that buy property rather than buyers agents that do research. And so having that focus was key for us, because it meant we were led by the numbers. We were letting emotions and things come second in the equation. And so from there, it's allowed us to form methodologies which give no bias. And that's how investing should be. You shouldn't have biases in many ways that people traditionally do, whether it's a regional city versus a capital city, or whether it's a city they like because they visited and the beach was lovely, or versus a city that's actually showing the right metrics. So it's a combination of these things that we're really trying to kill, and there's nothing better than that than research to do so. Okay.
So as we get into the discussion today, we're going to explore your methodology and give you the opportunity to tell us a little bit about it, because I'm interested to learn more, and I'm sure our viewers and listeners are as well. But perhaps we could start by having a quick review of what happened last year, because as I'm sure you'll recall, about this time last year, we were being told by the wise people who are senior economists for the major banks, for example, that we're going to see some pretty serious price decline across Australia because interest rates were rising. Now, I think what we actually saw was something quite different to that.
Yeah, I think the biggest learning for everyone is that it's another moment of it wasn't as bad as you thought it was going to be. And that's the biggest learning I think many people are having at the moment. Both, I hope economists are, because they seem to be the ones that keep throwing out the opinion and miss it by a mile. But I know that many people are learning it's not as bad as you think it's going to be. And I think the first taste of that was the pandemic. We had something that has never been seen in recent times. And as a result, people felt something was going to happen and the opposite happened. And so this whole thinking of this bad thing is going to happen, I think, and I hope Australians are getting smarter and smarter as time's going on, and we're taking a step back and going, hold on a minute. I don't think it's going to be as bad as everyone says it is going to be. But sadly, there are a lot of opinions out there with a lot of ability to generate lots of eyeballs, Terry, and lots of ears open for the noise to come in.
Yeah.
And that's creating opinions that are the otherwise. But last year was a very strong market. Housing markets over the last year actually had a lot of strength. And I want to share one thing before I go into a bit of a share screen of what we saw last year. And that was that people should take a step back to truly understand the purpose of interest rate setting. This understanding will help people realize that whatever you're thinking is going to happen, it's probably the opposite. And so how I think of that is I take a step back and I go, the old Simon Sinek, ask yourself why many times, and let's see what comes from it. So wait, interest rates are rising. Well, why? Oh, because we have a high amount of inflation and a very strong economy. Oh, well, why? Because people feel confident, are out there spending a lot of money, are out there having job advertisements and wanting to grow their businesses, right? And so when you have a lot of this factor, I ask myself, is that a bad thing or is that a good thing? This is good. Having prosperity in Australia, having strong amounts of ability to spend, capacity to spend, comfort to spend. Then on top of that, the ability to go out, get a job, and demand pay rises with wages rising, unemployment falling, job ads rising, infrastructure in high levels. Of course, they're going to rise rates when you see all these things.
Yeah.
And so when you're doing that, that is a clear impact that, well, prices rise following strong economies. Terry, both you and I have studied that for many years, which is
Yeah.
prices rise in strong economies.
I think a lot of people would be surprised to learn that most of the spectacular property booms we've had in Australia since the 1980s have happened during times of high and rising interest rates. Now, it sounds counterintuitive to a lot of people, and it seems counterintuitive to the economists working for the major banks who seem to think that rising interest rates mean prices will fall and low interest rates mean prices will rise. But the reality is, because of the reasons you've just articulated, that we're more likely to have a boom when interest rates are high, because interest rates are high because things are prosperous and people are spending and confident, and the Reserve Bank is trying to dampen things down a little bit.
Yeah, you've raised a really good point to how people need to look at it with the opposite view. So I tell someone, hey, okay, let's just say interest rates are going to rise and prices are going to decline. Let's talk about the opposite then. Interest rates fell the most they'd fallen between 2012 and 2020. Why did Brisbane not boom? Why did Adelaide not boom? Why did Perth decline 25%? And why is it that Melbourne went on its own run, Sydney went on its own run, a few surrounding cities to them went on their own run? And then just as interest rates continue to get lower, Melbourne and Sydney decided to decline between 2018 and 2020, even though we kept getting lower. And so this whole analysis of one singular data point rules everything, and direction A equals everything else follows, or direction B equals everything else follows. That's what we need to stop as property investors.
It's kindergarten analysis, really, isn't it? And it's ironic that we're getting this from some of the most highly paid economists in the country. What I love about what you do at InvestorKit is you have a much more sophisticated way of analysing markets. You've got 25 core fundamentals, and I know you're going to talk to us about that today. With your presentation, I'm really keen to learn more about this, because I think what you do in analysing markets with the number of data points you look at is probably the most sophisticated that I've seen anywhere in Australia.
Yeah, thank you so much, Terry. So this fundamental analysis, for those seeing this for the first time, this is a free research paper that's available on our investorkit.com.au website, and that can simply be accessed through resources and white papers alongside a few more. Now, with this research report, Terry, this is our, I think, third edition now of running this. And to give people the insights of what happened, just so we can see what followed along, 2021 was our biggest year. And during that year, somewhere between 22 of the 25 fundamentals were either strong or very strong. And we've got sort of 5 ratings, very weak, weak, balanced, strong, very strong. And then when we look at the year that things still did pretty well, which was 22-23, 17 of the 25 fundamentals were strong or very strong, which is still a great number. Now, in the most current financial year heading to June ending this year, it was 16 of 25. Again, still a healthy number. But with some changes ahead, which I'm expecting to see, that number will lift from 16 and be even higher and taking it to 25. Now, from that perspective, if we go and say, well, what's the purpose of this 25 fundamentals? Well, firstly, this is to understand macro housing. And Terry, both you and I know that you can't take macro housing data to make an individual house purchase decision. What macro data does for us is it gives us an understanding of the tea leaves, just kind of what's happening, how people are feeling at an Australia level. But then when it comes down to the cities, every market is a market within a market. And that's when we looked at the more isolated market pressure review, which is more so pressure of a certain city by some of the individualized indicators, not to do with the good news or the bad news story, just straight up numbers, whereas the fundamentals are the storytelling of Australia. So those listening or watching, when you're looking at fundamentals, do not judge your individual house purchase by a fundamental. Use the fundamentals to guide a deeper understanding and use pressure to judge an individual housing decision. Terry, if we take a look at, I guess, the core things on this fundamentals, I want to firstly go back to what we had as a reflection on the 2022 market pressure scoring, what we predicted versus the actual outcomes. So we had deeper than the fundamentals, which was pressure, and some of these pressure trends, I have to say here, Terry, we learn a lot from each other, as you kindly pointed out your thoughts here, but I learned a lot from you and I continue to do so. And one of the key things you highlight is some of the lead indicators, one of those being sales volumes. There are also many other lead indicators that all come together to create what we call pressure. And so from this pressure review, we saw that 10 or 91% out of the 11 cities that we scored 4+ for pressure, so either high or very high pressure, achieved price growth in that following year of the report. Then of those 10, 6 were double digit. So we can clearly see when we have pressure that's high or very high, we tend to see price growth or high price growth. Then 7 of the 8 cities, 88%, that were scored 3 in terms of balanced, saw price growth. Because when you're balanced, you can still see mild price growth. But 5 of them were single digit. So the majority were single digit, which they should be when they're balanced pressure. And then 11 out of the 14 that were scored 2 or 1, very low pressure, saw extremely mild price growth, but again, with low pressure, half of them declined. So that does mean there are some markets that saw the opposite. And this is the beauty of pressure. We can start to see that. This was last year's prediction, which showed the early parts of where pressure was building last financial year. And this is some of the things that came out to be in this data that we analyzed the year following. And I guess some of the areas that we talked about that had very high pressure, we can see in Queensland, the previous financial year's report pointed Townsville for imminent growth, Rockhampton and Bundaberg, Toowoomba as some examples. Adelaide in the major city, and Perth moving from a balanced over to high, which it did in this year's report, and Bunbury, which remained high as well in the regional WA market. So I think the clear picture here is that the regional cities were more the winners, and some of our smaller capitals over the pressure review that we did the financial year prior. And that's then that prediction piece for what happened in the year following. So going into the methodology, Terry, before I jump into that, I just wanted to highlight that we wanted to capture the data across as many cities as possible. When we look at the methodology, we're looking at our major cities firstly, but they aren't the only ones. So we took also our 25 most populous major regional centers as well. And that gives Australians plenty of areas to see in terms of areas to potentially buy in. Going over to the actual fundamentals themselves. And so with the fundamentals, we divided them into 3 core areas, which is simply what people are doing, what people have available, and then how are they feeling. That's the simple explanation to the words demand, supply, confidence. What are you getting up to? what's out there, and how you're feeling. And so I always love to try and turn data into barbecue statements, because if we can't talk about it at the barbecue, how's the uncle or auntie at the barbecue going to feel empowered with this research that we give them today? And that's the key. And so when we're breaking this down, Terry, the first thing I want to start off with is how we start to categorize these subregions of data, example demand, into even more micro areas. So in people movement, this is one of the most interesting ones. People just isolate population growth. There's so much more than population growth. You've got to cut it down to deeper levels. Let's talk population growth at a large level, overseas migration, regional migration, visitors, because they spend cash, they spend dollars, and that increases prosperity for areas. And one interesting one is you can have people move and create more households even if there isn't any new people coming into that location. So household size also plays a movement. And this is categorizing it to people movement, not so much the word population. People sometimes oversimplify and just go population growth. Well, no, it's people movement, and you can move in so many ways, upsizes, downsizes, and so forth. Terry, did you have any questions on these ones we should run through before I continue to run through a few more of these?
Look, I've got a lot of questions. I don't want to interrupt your flow, but I'm really interested in the household size factor, because we've seen different trends, haven't we, coming out of the COVID era rather, in terms of household formation and the impact that might have on demand in an area. It's not just, as you say, how much population is growing in a particular area.
Absolutely. And household size can kind of see two different things come into play. One is monetary or financial impacts can cause size changes. And second is demographics or generational data in terms of age, and certain movements in our birth rates can also change this. And I'll try and break this down a little bit further. So if we go back to the era of the 1970s and 80s, people, let's just say, were a lot busier in bed than they probably were today. So we had the average birth rate a whole lot higher than we have today. And as a result, that creates a different dynamic of generations. And then those generations grow, and with age, where we are today, they move into what we call household formation stage. And so in some of this learning and data, it isn't just about what I know about property. It's about me learning from other experts, like Simon from the demographics group, who continues to educate us a lot on the demographic side in terms of his catch-ups with myself. And what he talked about was household formation, the millennials and the Gen Ys starting to create families. And unfortunately, not unfortunately, but I guess not many families will all decide to create the compound like I have with my family, where all of us moved in together and we have 11 of us under one roof. Many family members decide to actually create separate households. So that same group of 4 people in one household may now become 2 households of 2 each. And this now, without any more people, has created an extra family that's now demanding an extra roof above their heads, which is this demographic shift, the household formation stages, and the Gen Y and millennials that are starting to create a lot more households, which means whether COVID happened or not, we would have seen this happen, because we're just reaching that age point, right? And then you have the opposite. The opposite is to do on the financial side. When you start to see large financial pressures mount up, it's much easier to divide those financial pressures, as we see in some parts of Asia, where those high rent to income ratios, people divided by having people stay in one dwelling. It's common in the likes of New York, it's common in the likes of many other parts of the world, and starting to be in some parts of Sydney. And so I think this is where people look at household formation in the opposite direction, where its costs are too high, people start coming together again. At this stage, that household size dropped in recent years. And as a result, that drop in recent years created more demand for housing, but the construction and supply for sale or rent just did not follow. And that's part of some of the things we saw.
Okay.
Looking into some of the other aspects, I'll go through a couple of them in just quick detail, but economic activity, this is by far, in some of my learning in recent times, been the earliest indicators you can get to market success. When you start to see a recovering and thriving economy, it does flow on to the rest. And it's just a matter of when, not if it will or not. It is just a matter of when. Now, that is when we come to pressure data that tells us the when, because I always take a step back from data and I ask myself this one question. If people are, I've never seen a market where prices have grown, and I'm yet to see it. In history, it hasn't existed. People take longer to sell. People don't buy enough real estate or much real estate. People have lots of real estate available. People are giving a lot of discounts as they sell real estate. Lots of constructions occurring for sale. A lot of properties available for rent. And then on top of all of that, prices grew. There's never been a time in history where this happened. So when I realized that, you take those indicators and turn them into the opposite, that is essentially a growth market on the pressure level. More people buying, not enough houses, not enough construction, not enough for rent, quicker selling. And as a result, this comes together as creating pressure.
Yeah.
And for that pressure to occur, it starts with the economy. And that's why this economic data is so important.
Yeah. I'm really interested to hear you say that, because we certainly believe at Hotspotting that real estate markets are very local in nature. It's they're influenced perhaps by broad national factors, but the most important things are what's happening locally, and it all springs out of the local economy. A strong local economy will usually result at some point in a strong local property market.
Absolutely. The local economy is the earliest indicator. And so from that perspective, I want to give a case study while sharing this. People would have seen, hey, Arjun, why was Townsville a year and a half ago, 2 years ago in your data here saying that something's about to happen here? Because people saw past growth with little to no growth. People saw crime and heard that it was high. People heard about weather events. We've studied weather events deeply. They tend to have a V-shaped recovery when weather events occur. You can see it now, Terry. You would have seen Lismore's sales volumes are flying off the roof. And they're not flying because Lismore's a hot market all of a sudden. They're flying back because you get a V-shaped recovery post an event where it sucks out a lot of volume of transactions. And so it's quite common and will continue to happen. It has happened in history. But coming back to the economic point, using Townsville as a case study, 2017 and 18 would be some of the roughest times of Townsville's history, 16, 17, to be honest. Crime extremely high, unemployment's over 10%, prices probably reaching a decline point from 5 to 20%, depending on a 5 to 10 year average of how far you take it and which suburbs you're in. And also starting to see all the signals that you could see that don't look pretty. Now, housing pressure data would have told you why you even considering that. And it makes sense because there wasn't any pressure. But economic data in the years to follow started to show the first signs. And so 2018, we saw the city deal of Townsville, and infrastructure of all types started to come through to the picture. And one of the most important infrastructures that one can have is social, lifestyle, recreational. I put this all together because it doesn't have an impact at the time of just the jobs of creation. It has the impact at the time of the usability ongoing, jobs ongoing, and then the appeal ongoing. An example of that are stadiums. Another example of that are hotels. Another example of that are certain precincts for retail and, enjoyment, tourism. These things have an ongoing effect. And even though they might not start with the billions at times with the wordings, they can sometimes be more powerful than those infrastructure projects that are a large road or something along those lines. But nonetheless, Townsville was met with falling unemployment. It was met with increasing infrastructure per capita. It was extremely affordable coming off a lull period in relation to the local incomes. And at the same time, because you have a lull period, builders aren't very excited to build after many years of price declines or price weakness. And so construction lagged. And all these things came to show fundamentals that were strong. And here we are today with it being one of the hottest markets in the nation right now, seeing over 1% per month average growth rates over the last 6 months, as reported by CoreLogic. And so I just can see that economic activities we pointed out earlier alongside people movement will be core areas. Now, to finalize my summary here, these things come together, which is the fun stuff everyone likes talking about, finances. They do play a part. We can't completely ignore them, but they are a part of the greater puzzle. Affordability. I have some interesting views on affordability. I like to look at it from multiple angles rather than it's just costlier today than it is yesterday. That's the most common used by media and locals to a city. They just are unhappy that it cost more today than it did yesterday, and therefore define a city as unaffordable. I have to simply say that if someone is transacting, it's technically affordable, because we have some of the most strenuous tests globally for obtaining a loan. You might be at a 7% interest rate. Well, guess what? The bank's thinking you're at 9 to 10. You have a credit card today with no spending and you're the cleanest credit card user. Well, guess what? The bank thinks you're a nutter and you're absolutely maxed out your limit. Just when you think that you're spending good for your household and you're a great budgeter, well, the bank has a minimum expense limit that they're throwing on that is probably more than you even spent. So just when you think you're a great hard worker at work, you do lots of overtime, you get lots of commissions and bonuses, and the boss loves you, well, the bank's only taking 80% of that anyway. And just when rental markets are rising and you're happy with your rents and they're rising and your tenant's great, they pay it on time, well, the bank's probably only taking 70 to 90% of that too. So the main thing we want to share here is that we have tough conditions for good reason, because we have a healthy credit system here. But even doing so, people are transacting, which is clear signs to say that affordability is not an issue in Australia yet. And so we looked at affordability in a few different ways: rental, mortgages, price to income, not just the isolated price to income that media technically reports on. And so these are some of the ways, and anyone wanting to look at this further can deep dive into it. And we try and even give you the links to say, hey, where do we get this from? So we're not here, hiding on fundamentals that are just hidden data. This is here for you to check out. The sources are public. Then we move to market pressure. This is the fun stuff, Terry. This is the stuff I really nerd out about, which is more like charts and numbers and metrics and seeing patterns. Because as I pointed out that statement before, there has never been a local market that has grown where all the bad stuff that we talk about of time to sell, number of transactions, has happened. And so you look for the opposite. Are people asking for more, selling quicker, buying more, discounting less? Stock levels, how much is available for rent movements, and other indicators like auction clearance rates, depending on the city type. And so as we move into it, Terry, this is the part where we move into the ratings. And this is where we move into the ratings of this current financial year, using some data from late last year. So this is a report we released late last year, but many of these will never change the actual indicators. The indicators remain the same. It's just how they move is what's kind of fascinating right now for 2024. So population growth will start there, is very strong in Australia right now. And net overseas migration is also very strong right now. Regional migration, for those who thought COVID was this one and only thing, it's always been happening. Terry and I, we caught up yesterday, and Terry, you pointed out some data around some cities that have kind of almost been losing people all the time for 10 to 20 years, right?
Yes.
And so as a result,
that trend of people moving to the regions was not inspired by COVID, and it didn't end when COVID was allegedly dealt with. It's a very long-term trend, and it continues.
Absolutely. And migration from capitals to regions outweighs the migration from regions to capitals. For those thinking that it's over and people come back, it's not the case at all. International visitors, they're coming back. They're very much back, and more to come based on what we're seeing here. And then household size falling and decreasing. This is also strong. Now, some of these data points, obviously, there's some recent updates that have come in since we launched this report. But the key here is to say that people movement is all either strong or very strong in Australia. If you take the year's prior release, obviously the borders and everything like that weren't in full force, so they weren't as strong, but now they are either strong or very strong. If we move to economic activity, let's point out some of the more balanced and weaker criteria too, because I think this is important. If you have a methodology of 25 points, you can't have a methodology of 25 points and just assume everything always is strong. You've got to look also for the weakness within them. Now, naturally, when you're going to try and put brakes in your car, and then you're going to fine tune those brakes in that car and make them the strongest possible brakes you can, e.g. interest rates, you're going to start to see a manufactured slowdown in some of our output in Australia. That's actually engineered. It's designed to do that. And as a result, unemployment likely will increase, because this data is from prior. Unemployment's at about 4.1% now, and we expect it to increase. But at the same time, the resilience levels the unemployments have are so strong in comparison to other parts of the world. Unemployment rates right now, based on this interest rate setting and the speed we've had, I would have thought it would have been somewhere between 5 to 6% by now, but it's just not. Shows you the resilience of where we're at the moment. I would expect it to rise, and even if it does, whilst it sounds and probably is a little painful, at the same time, unemployment balance marks, depending on which economists you speak to, say that 5 to 6% or 5.5, some even say 4.5 to 5.5 is that balance point. So it's still in a very strong point. Infrastructure investment is very strong across the nation. We are in a true infrastructure boom, and it's likely to stay this way until about 2028 from the data we have available so far. And who knows, as the years progress further, there's probably more to come in the pipeline that will be added. But right now, this is a huge story. And again, had interest rates not gone up or down, had COVID happened or not happened, this number would have still been just as large. And the key is this would have created a lot of prosperity.
Arjun, I'm interested in how you benchmark that. You've ranked the current level very strong. Is there a benchmark that you compare to arrive at your ranking for that?
Absolutely. So we've had a look at it from historic data that we've collected over the years to understand the trends of infrastructure. And so I always believe in what we call 5-year totals or 5-year averages. And that's a good way to look at trend analysis. So infrastructure is well above the averages in recent times. I was reading somewhere in some deeper infrastructure reports that like the level of spending that's being had right now is almost as high, and as crazy as it sounds, it reminds many of those who track infrastructure to the days when our cities were actually being formed. That's how much spending is alive. Imagine like the Harbour Bridge being formed. Imagine the Opera House being formed. Like these are like levels of infrastructure in terms of the spend. Obviously, the dollar back then was different and the dollar today is different, but there is a lot of spending is what I'm trying to get at. For context, for those who travel around the globe and see monuments in some of the world superpower cities like, say, Dubai, where I was at recently, it was over $1 billion spent on the world's tallest building, the Burj Khalifa, and huge engineering feat. There's about $6 billion spent on a railway in Brisbane. So that just gives you some insights about what's happening in terms of the spend in Australia with the population, and Australia not known for splurging the cash that Dubai does in terms of the global perception, yet here we are doing so. So there's a lot of money being spent.
Yeah.
Commodities have come off a little bit off the high that they had, but they were very strong at the time of producing the report. And coming off that high, we expect it to continue to come off a little bit and balance out. But it's still ranked at that strong position. However, if I was to run that report again, it was probably landing towards balanced, depending on where things are towards the end of the year. If we're moving to finance, this is the interesting one everyone should really start paying attention to. We're obviously at a weak point of cash rate. Now, remember the rise up that Terry and I spoke about earlier, the rise up was the strength of the economy. But when you're up too high for too long, you're at a weak point because you're manufacturing a slowdown. So technically having it too high for too long is a weak point. Now, the anticipation, though, is that over this year and next year, we should start to see this come down, and it will continue to be a strength. Now, it's important to note that if we stay here for too long, I am of the opinion we're overshooting, and we're going to see this number of unemployment deteriorate even further the longer we sit here. So let's hope smarter brains on the policy setting table prevail, and they can come to realize that you can use metrics not just to be rear looking, but forward looking, because a lot of what they do is a lot of rear looking stuff. And if we're looking forward, well, we're probably going to be sitting here for too long. And I think we're already sitting here for too long. And it's just a matter of when the data catches up to say the picture. And so from that perspective, this should slow down. But this is the part that people probably should come back to the original part that we spoke about, which is even if it slows down, it does not mean that we go into boom territories just because monetary policy becomes cheaper. And this is the biggest learning I personally had in 2024 and 3. In 2023, I think the biggest learning I had was the difference between credit supply and credit take-up. This is two very different things, yet everyone puts it as one thing. The big label that everyone throws is the word borrowing capacity. And borrowing capacity fell 5, 10, 15, 20, 30, and at some point it got to a 38% peak in terms of drop-off. But what people need to recognize is there is a difference between credit availability, that's the supply of credit, which interest rates increasing declined. But then there's credit take-up. Credit take-up is someone's desire to take the credit accessible to them. Credit supply is what's available to them. So whilst, yes, the availability declined in Australia, the desire increased substantially because the finance did not drop off 40%. It dropped off by just over 20%, which means the net drop off is greater. So it's actually better. It's weird, right? This is the thing about data that people need to take a look into. A decline of 20% in borrowing usage is not a decline of 40% in borrowing availability, which means the net increase is people still had a 20% increase on availability of borrowing capacity. And that's something that people might get going, I didn't think of it that way, which is, yes, I could be available and giving you less by 40% of borrowing, but you only dropped 20% of your take up, which means you wanted to take more. And so that's the key part. There were households that took more and they continued to take it even as the borrowing capacity was pulling against them. And this is where people need to separate this. If the interest rates come down, which they will, the key is if they continue to see this number go up, then yes, you might have the availability of money pick up, but it doesn't always mean people will take it if this number goes up too high. So the two balancing edges are that policy and also the jobless rate. So if we have that jobless rate not extend too long, this should remain strong, where this should get stronger as this comes down. And that's what people refer to as what they call a soft landing. That's the perfect world. Household income. For those who forget, wages have been rocketing away. Now, we can argue if that's real growth or not with how high inflation's been, but inflation's clearly turned a corner and wages remain high. Wages remain strong. So that is a big resilience piece, and that is a big strength in Australia. The next piece is household savings ratio. It is still positive because it's not like it's negative. So people are still saving even after these costs, but it is substantially below our long-term averages of that sort of 7 to 8%. I do expect, though, as interest rates start to come back off, you see this number come back on, because the only difference between this number being high and not was this number going up. And so this is where two weak fundamentals could change to strengths in 2024-25. New loan commitments have been improving, even as interest rates have been high, and even though interest rates technically have not come down, people are taking up more finance. So that's the whole credit take up versus credit supply. We're giving you less credit, but more people just want it. And then one of my favorites in Australia, it's actually these two, is every time there's a bad news story or a potential for a bad news story, people forget that we're only geared in Australia to about 1/4 of property values. And that's a big learning lesson for anyone out there.
So is that stat, Arjun, telling us that there's almost 80% equity? Is that what it's telling us?
Absolutely. So there's a lot of households that do not need mortgages, do not have mortgages, and those that do, as a proportion of the total pool of value in Australia, are having a low amount of lending in the current place.
And we continue to have very low delinquency rates, don't we? We're told to expect that to soar, that we're going to have a mortgage cliff. None of that has happened, really, has it?
The cliff seems to be the favorite word. When I was in my banking days, it was the interest only cliff. After my banking days and turning into the property, it was the fixed rate cliff. And then now there's the delinquency fixed rate part 2 cliff off the back of interest rates rising. Now, yes, I acknowledge that there are more fixed rates to come off, and it's not easy at all for many finances that have been shaken up. But we did some modeling around the proportion of households that would be impacted, and this is where the stats get really interested. About 10.4 million dwellings exist at the time of us doing this modeling. About 500,000 to 600,000 transactions occur in a given year. So what we can say is that the 2 years in which household data of buyers was at the lowest interest rates we've seen in the history of the country represents just over 1 million transactions. So that's the year of 2020 and 2021 when interest rates were just super low. Now, during those million transactions, of the 10.4 million, that's under 10%. Now, let's not forget those million transactions that took place are not all first home buyers. Many of them are investors with equity or low LVRs. Many of them are upsizers, downsizers, existing homeowners with built equity, homeowners who've owned homes prior. In fact, PEXA released some data recently that suggested up to half the transactions in the nation over the last 12 months were with cash purchases. Unreal.
I'm interested, Arjun, in looking at your indicators for affordability, because we've seen a lot of indicators so far in your fundamentals that have been quite strong, but these ones seem to be the weakest in all the fundamentals.
Absolutely. And this is where it points to what's happening in 2024. So firstly, if we look at these weak indicators, the borrowing capacity weak part is expected to strengthen as interest rates come down. So we should see a transition from weak to strong as time goes on here. Rental affordability, I do expect that to remain weak. And I do honestly say this, that there are two things at fault, potentially three things at fault if I was to summarize it. The first thing at fault has been our governments and policy setting. Years and years and years go by, and the commitment to social housing as a proportion or a percentage of spend continues to decline. So that's the first part. So the governments that we're all voting in are doing less for creating housing for the greater community. The second thing is those who are creating housing continue to get penalized. So when there is a pool of properties available for rent, renters are now looking and the pool continues to shrink because investors leave. They're stale because of taxes, costs, ability to maintain a portfolio. They don't believe that it's in their best interest to invest in property. And that's sad if that becomes the case long term. And secondly, investors are pinged at all levels. It starts with the banks. The banks firstly charge you a higher interest rate to get an investment loan. They charge you even higher to get interest only. They don't let you as much loan to value ratio as an investor that they do as a homeowner, even though they'll still put you to the same tests, if not more strenuous tests in borrowing. Then it goes to the governments. Ah, lovely. Welcome to investment. We'll charge you a tax for owning it. We'll charge you higher rates in some councils. And then we'll charge you stamp duty and everything on top. Some of these taxes have remained. Some of these are being brought in. And then we'll continue to dangle the carrot of juggling around your claimability of tax and other things. And we'll keep scaring you in making more decisions and creating more paralysis by analysis. So that's the part with rental affordability. It's not going to get better. And then the final piece is our construction red tape. We need to construct a lot more, and we also need to do so at a level that's not just bringing on the mums and dads, because the mums and dads of the current construction volumes we see just aren't going to fix the problem overnight. Institutional money, super funds, global cash, if we have the taxes, which is a work in progress through the build to rent, that can be structured in places where the zoning's right, the land release is right, the taxes are right, the red tape is reduced, and we can start to see large-scale products at large volumes through money that wants to keep it as rental housing long-term. So these are the three core areas we see.
So I just wanted to remind everyone watching, listening, that we welcome your questions. If you have any questions for our Arjun, our guest presenter today, please type them into the Q&A panel, and we'll do our best to answer as many as possible in the time available. The other area, Arjun, that where the marking seems to be weak is in the area of confidence. That's one where we're particularly the consumer sentiment index very, very weak.
Yeah, so finalizing, I guess, this transition here, just to quickly go through mortgage affordability, Terry, we expect that to get better. So this will transition. And then as a result of wages rising, price to income ratio will improve, although it should still remain weak. But coming to sentiment, you've nailed it. Sentiment in recent times has been weak. And in the latest data release, though, when we release next year's report, this will be improving. We've already seen in the last couple of quarters, sentiment has started to see some improvements, but it is coming off the lows of the lows and the bottom of the bottoms. So it's clear people aren't feeling the best. As sentiment in scoring is one way to look at it, from the banks, Westpac Melbourne Institute, all these different ways, Roy Morgan, there are different surveys and things that measure it. But another way you can measure it is through the millions of impressions and clicks and eyeballs that the media throws out there. And so we created this unique tracker internally where we take the 3 largest umbrella companies of media in Australia and all their subsidiaries attached to them. And then we have, using AI, we track what's happening across these areas of all the articles they put out on the internet. And we'll then scrape all the articles they put out on the internet, and we'll look at keywords to track whether they fit under 3 categories: positive, neutral, negative. So if they use lots of titles, notes of distress, homeowners, declines, forecasts of declines, a lot in the articles, then that sits in the negative bucket. And then we sit back and we measure the statistic over quarters. And we can see here that this did not score so well in the time of releasing this late last year, which is the media not being the happy, markets of property and saying everything property was going up. So only 17.9% of the articles are negative, right? Significantly lower though than the 32.5. So that's why whilst it's weak, we actually were not very, very weak. And so from this perspective here, we're at the score that's kind of in between the two in the weak section. In recent times, when we refresh this data of the last quarter though, which is not updated in this data, this was scoring balanced, which leads me to the point we come back to. 2023/4 financial year, we scored, when releasing this report late last year, 16 of 25 fundamentals. But I just want to go back and assume at the end of this year, we're going to run another report. Sentiment improves. Could this be 17? Well, TBC. Mortgage affordability starts to improve because interest rates start to change. Could that now be 18? Borrowing capacity improves as interest rates change. 19. Household savings ratios improve as interest rates change. 20. The cash rate improves. 21. GDP growth starts to get a new wave of push through it because they're throwing interest rates lower to hopefully recover output because they want the economy to pick up again once they realize they've overshot it. Could this now be 21/22? And all of a sudden, if all of this happens, we're back to 2021 data, which is 21/22 of 25 fundamentals, either being strong or very strong. And so this is the things that could change.
Arjun, you're suggesting that if those eventualities evolve as you expect, that we're going to be having a similar level of strength in your fundamentals as we saw in 2021, which was quite a notable boom year.
Yeah, so there is very much the possibilities of that occurring. I think when it comes to how much percentage-based growth, I'm here to say I don't think will be as much, because the first time you go through policy setting, which is around all the monetary changes, the infrastructure, all the spend, the borrowing capacity unlocking, the supply being constructed or constricted, all of these things that came up were at an extreme wave when we saw 2021's boom. I don't feel the way down in interest rates will be as fast as 2020 and 21 did. I don't feel all these dials that will change from weak to strong will be at the same ferocity, but they will eventually get there. And so when they eventually get there, not the ferocity, but the rating of strong, it means we're back to a position of 21/22 of 25 fundamentals, which means you could expect anywhere sort of between 8 to 12% plus growth in certain cities, which is boom territory. Many people feel that booms need to be 20% in a year. Well, long-term averages, might I remind everyone, is 5 to 7% in Australian real estate. So if as soon as we're traveling in the 8 to 12, that is boom territory. And so from that perspective, I do assume that should we find a balance and not crush this number too hard, because we are manufacturing a crush of this number. That is why, whilst interest rates are rising, the heat is still on, hence why economies and housing markets continue to perform. But there is a point where the interest rates just get to too much, and that point is staying at that level for too long, and then the inflation is coming off, the prosperity is coming off, the economics is coming off, because more of the money is not feeding into our economy, more of the money is feeding into just paying our debt. And so that is the part where I hope we don't stay here for too long. We start to see this come off. And with the fine balance between this and unemployment and GDP, we should see indicators return to 21, 22 of 25. At worst case, 19 or 20, which is still a stronger year than we've seen in the last 12 months. So I'm expecting a pretty healthy year for real estate to end this year, should some of these fundamentals play out.
Okay, so it seems to be, in terms of the question we asked at the beginning of the webinar, the title of the presentation today, the answer we seem to be heading towards is yes, 2024 could very well be not only as good as 2023, but better.
Absolutely. It can very much be that. And the key thing to look is as you're looking at the data, get micro, don't stay macro, because remember, we have a data weighting issue in Australia. 2 cities and their surrounding cities put together represent more than a half of the nation's population and transaction data on housing. So the 2 cities that are currently still trying to get back into momentum are Sydney, Melbourne, and their surrounds. And if they continue in that momentum that's not as strong, whilst we may be correct on our fundamentals for what's happening across the rest of the nation, the national figure may not reflect that as cleanly as it should. So it's important that as people review that data, they just remember we have a data weighting issue in Australia. You could see a boom happening in Perth and Adelaide and in Townsville, and the national data just won't show that.
No, that's right. Well, it brings us back to one of the core issues, doesn't it? That we don't have an Australian property market, we have local markets. And so much of the media talk is about the Australian property market. And it really doesn't help us very much, because what we saw last year was a tremendous difference just in comparing the 8 capital cities, for example, on how much prices grew or didn't grow. Amazing variance.
Absolutely. And I think for those who saw some growth last year in the likes of Sydney, Melbourne, one of the biggest mistakes people make is they put the same word growth into the same bucket as recovery. Remember, growth and recovery are 2 different things. Sydney and Melbourne recovered last year. They didn't grow. That's an important part to recognize. The only people who saw growth were those who purchased a year and a half ago, because they saw growth. And if you can separate that, then when Sydney does do pretty well at some stage, it's important to look back and go, oh, no, it's not as good as the 13% it did the year prior. Of course not, because that was recovering the 10% it lost the year prior to that. So it's important to recognize that if it does do a 5 or 6% year this year, it is still actually a decent time of growth. It's in line with long-term averages. And it's actually technically better than the 13% it did the year prior, because all the 13% the year prior did is just load up the losses that it had. So it's important to recognize differences in recovery and growth.
Okay. So once again, people watching and listening, please let us have your questions. We still have a little bit of time available in today's webinar to take your questions. Type them into the Q&A panel, and Arjun and I will do our best to answer them. We have one of our audience today making the comment about, first we're talking about household formation, I think. First-time buyers that were previously living at home with parents, they buy a property to live in that was owned by an investor. That's one less rental property, but still a tenant that needs a property, therefore a drop in vacancy rate. How much of that kind of activity are you aware of? Is that part of the falling vacancy rate equation?
Yeah, most definitely, Terry. It is part of it. And that data is on the up right now. What happens is there is a statistic that points to X rental properties going for sale. And that data point is sitting somewhere between 20 to 30% levels, an increase in recent times, which means that a few more investors than typically in the past are offloading properties and making them for sale, which means that that pool is shrinking. And as we know, home buyers dominate transaction volumes in Australia. So if an investor lets go and a home buyer dominates, whether it's first home buyer or existing home buyer, then naturally the pool will shrink slightly. There is some good green shoots though. The good green shoots though that we're seeing is that investors are coming back on finance take-up. And investors coming back on finance take-up are lured in by 3 prospects. Number 1, they thought it wasn't as bad as they actually thought it was going to be. So people are doing what they did in COVID again. Oh crap, lost times, I better catch up on it. And that's the first thing we're seeing. The second thing is investors are lured in by the prospects of rental yields increasing. If we look around Victoria as an example, there's a true recovery shaping there. 0.5% increase in rental yields have occurred in many cities just in 12 months. And that's not because, rents are crushing it and it's just in isolation. It's actually also because prices have stabilized and or declined in some cities in Victoria, but the rents continue to grow. Melbourne is an example where rents went up by 10 to 12%, but house prices in some regions went up by 2 to 4 and declined by 2 to 4 in others. So that's an example of rental yield. So rental yield will lure investors. That's the second part. And the third and final part is that investors don't just use today's fundamentals. They speculate about the future. And so their speculation of the future is that interest rates tomorrow will be lower than today. And so at the end of the day, whether that tomorrow is a 6-month, 3, 12, 18, who knows? I don't know that. But the main thing is they expect that to be lower. And so a combination of interest rates, a combination of rental yields, and a realization that the times weren't as bad as they thought is going to lure investors back. So I'm hoping for that to give some ease of pressure to our vacancy rates moving forward.
Okay. Another one of our viewers says, it seems at some point the Reserve Bank will reduce the cash rate. So far, we've had a vendor's market. I'm interested to know if you agree with that. But will we get a buyer's market when rates decrease?
Yeah, so I think the first thing is history tells us a lot. So the history telling us a lot here is that in 2012 to 2020, we can just go back in time and see how much interest rates declined. And so when interest rates declined with the ferocity that they did during that time, we saw mixed results across the country. Pointed out earlier that Sydney, Melbourne boomed, Hobart, Orange boomed, Burnie, Devonport boomed, Brisbane and Adelaide were flat. Perth declined, Darwin declined. So what you're going to see is what you should always see, is property markets doing different things in different locations.
Yeah, that's right. Again, it makes the point, isn't it? We don't have one market, and what's happening with interest rates is not really the big determining factor. You've really got to look at some local factors to really understand the differences in markets and what are likely to be outperformers and not. Harry is asking, how do you see the owner-occupier market going the next couple of years with unemployment rising before interest rates coming down?
Yeah, unemployment rises are expected to continue happening. They're already increasing and likely to increase more. Just understand, though, that unemployment's also not meant to be this low forever. And so that's always been the belief of the central bank. And whether that belief is true or not, we can't really say much about it. I think the main thing, though, is that they want it unintentionally to kind of go higher. And so does it affect owner-occupier markets? Well, it affects everyone. It's not just a market segment of owner-occupiers. If people feel less confident and less capable to now get a particular property because of circumstances in their job, then that will flow on to property markets. However, unemployment, again, is a singular indicator. Do you know that Bundaberg was one of the star performers between 2020 onwards and still remains it today? But Bundaberg unemployments, by any means, were not the lowest, nor were they very low. They actually were quite high at some point at over 10% and hovered between 6 to 10 whilst the boom was happening. Now they've come back down. The job market's very resilient, coming back to 5s and 4s. But that alone can't be blamed for its boom. So I think the key thing there is to unlock that, yes, unemployment's likely to rise, but once you have a macro indicator changing, just realize it's going to have that impact on the nation. But deeper in local insights, you'll see varying unemployments. We have some markets sitting above the average of the nation. And then you have markets, for example, Townsville sitting at 2.7 in the last data review. So your job now as an investor is to look around the nation and go, where do markets have that strength? And if they have a combination of unemployment, a combination of job advertisements, diversity, infrastructure per capita, and pressure trends, and much more coming together, then you're looking at a pretty healthy market.
Okay, Karina would love to know how to go across the line of the third, fifth property where you've maxed out your serviceability. I guess you come across this a lot in your business. People have got a certain level of property and they find that they're with lenders, they've kind of maxed out their capacity. But Yeah, so it seems like Karina's in that position, wants to know how she can perhaps move forward from that position.
Absolutely. So I've got a long-winded answer on this one because there's a few layers to it. The first layer is what you can control. And I know this isn't the answer, but it's the truth. The truth is what you can control over time, and it doesn't happen overnight, is what you do for work, where you work, how good you are at what you work at, who you partner with, how many kids you have or don't have. These are all the things that impact calculations. And this is what I call within your ecosystem. And so I'm not here to say that because you're not in a certain job, you can't do property investing. By every means, everyone should be a property investor and everyone should grow their future, grow their wealth. But what I'm trying to say is there's controllable factors within the house. Now let's just say you're working on those. The next thing is something to learn about what I call the system. The system of the world relies on credit growth. When's a time where you've looked at a bank shareholder meeting or a shareholder report, and I encourage you to review this, and all the bank's shareholders, share prices, and everything is really happy about no credit growth happening? Never seen anyone very happy about no credit growth happening. And so what that means is the world is designed to unlock credit growth in some way or the other. It's been happening for centuries. So how does credit growth happen? One is time. We're seeing wage growth increase a lot. And time with wage growth percentage increases is one factor. Second is we're seeing banks' policy changes. Banks' policy changes and risk appetites change to the environment of today. And policy changes will also start to have competition play into policy changes. Bank C is always not going to be the best lender in terms of giving you the most money, because sometimes Bank A looks over at Bank C and goes, hold on a minute, they seem to be getting a bit of customers from us. We don't like that. Well, if we change our viewpoint to the way they're looking at it, we'll give you some money. Stay here. We'll give it to you. And so competition, policies, global credit growth, income contributors to that credit growth, shareholder greed, whatever you want to call it, however you outlook, conspiracy theorist or not, the truth is the world revolves around growth and credit over time. So as a result, time is the answer. Banks and competition is the answer. Brokers is the answer. Probably going to unlock something. So that's the second part, outside of the first part, which is your own control. The third part is real estate. Real estate has wide and varying yields in Australia and wide and varying purchase prices. Some rental yields in Australia are as low as 1.75 to 2.75, which is the rent times 52 divided by the purchase price as a percentage. And some rental yields can be between 5 and 7%. And so as a result, with higher rental yields will come on higher growth. And also with rental markets, it's not just about the yield, it's about rental growth. You could have a high yielding market at 5.5%, but the prospects for rental growth might not be there. But you could have a low yielding market at 4%, but the prospects for rental growth are far greater. So we believe in what we call rental pressure outweighs rental yield. And I've seen it. I've seen markets where the start timer 3 years ago, they were both in the same position, being like 500K markets, but one yielded 4%, the other yielded 5.5. And 3 years later, the 4% yield actually yields higher now than the same 500K purchase. And so you end up having that. Now from the property mark, you've got the property, you've got the credit growth or banks, you've got policies, extending loan terms, reducing repayments, these sorts of things. And then you've also got your own income position. So these are what I call the pieces on the chessboard that you do. The final piece, though, is structures. There are tactful structures people invest in, whether they be corporate entities, trusts, and so forth, but it's important to understand the pros and cons of them with your accountant. And I think when you engage and build a team around yourself, you're going to be able to build the right ecosystem to achieve it, which will build structures, finance, goal setting and strategy, and then you on this side will do your personal strengths, goal setting, career, income. I was actually talking to Terry about this yesterday, and it's my final point on this. Many people go into property investing to escape something. They go into property investing to go, I want to do this so I can stop my shitty job. I want to do this so I can stop doing this. I want to do this because I'm tired and I don't want to work more. After purchasing over 1,000 properties and having over $1 billion in property experience, I've come to learn one thing. Those who build the most prolific portfolios for their financial future tend to love doing it and love what they do. So if you can build those worlds together, and instead of using property investing as a getaway from something, you become more resilient, you become more patient, you become more tactful, you become more strategical, you become more, powered with the team around you. And then you're here going, well, I'm not here to use this as an escape tool. I'm here using it as an enhancer of my life. Everyone who uses an escape tool wants the 3 to 5 property plus yesterday. And that's the problem sometimes. It takes time.
Sure. Arjun, we've gone well past the hour. It's time to wrap it up. Anybody who would like to follow up and make contact with you or your team, interested in property investment, someone who has a question like the one you just answered about borrowing capacity once you get to a certain point, could profit by having a discussion, I imagine, with a member of your team. What should they do?
Absolutely. So I've got 3 things for people to do. The first is reach out to us if you're after a property or looking to scale a portfolio, looking to start your investing journey at investorkit.com.au. The second thing is, if you just like to stay in touch with me and see what I post on my socials, follow me on LinkedIn. My name's Arjun Paliwal. And the third thing is, if you don't mind my face and seeing it on the screen, check it out on YouTube. It's InvestorKit. And I love to share not only our podcast, but more videos like this, like with Terry, on that YouTube channel. So you can rewind, press play, go back, and start to look at this in more detail.
Yeah. And we do have in our chat box right now the website address for people who'd like to follow up and find out more. Arjun, thank you so much for participating today. That was a wonderful presentation. I learned heaps. I love talking to you because my passion is real estate research, and I know that's one of yours as well. And everything you do at InvestorKit comes out of the very extensive and detailed and sophisticated research that you do, arriving at conclusions that can profit anybody who's interested in property investment around Australia. So I do urge people watching and listening to get in touch with InvestorKit and find out more about what they can do to help you become one of those people who in Australia who has success in building a property portfolio.
Thank you so much, everyone, for tuning in. Really appreciate the kind words, Terry.
Yeah, thanks, Arjun. Let's do it again later in the year. I'm sure people would love to see you back talking about what you do.
Looking forward to it. Take care.
Okay, bye-bye.